You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
And hello, East Tennessee, and welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and as we move into August, we're almost halfway through the third quarter of 2025. It's really quite hard to believe. I think as we get kind of closer to the middle of the third quarter, it's a perfect time to pause and evaluate your financial progress for 2025. Just like an annual physical keeps you healthy, a quarterly financial checkup can help ensure that your money is working as hard as you are. You know, there's been a lot of market volatility this year. There are new retirement contribution limits. There are changing tax landscapes. Of course, we just had the big, beautiful bill. I think a thorough third quarter review is more important than ever. So in today's show, I'm going to guide you through a systematic approach to reviewing your financial goals, optimizing your investment portfolio, managing your retirement contributions, and implementing smart tax strategies. So whether you're ahead of schedule or need to make adjustments, I hope this show and this quarterly review will help you finish the year strong and set yourself up for long-term financial success. So we're going to talk about four major things today. We're going to talk about goal assessment and progress tracking. Are you on track for 2025? We're going to talk about portfolio rebalancing and adjusting your investments for quarter four success and exploding into 2026. We're going to talk about retirement account optimization, maximizing the new catch-up contribution limits, and also tax planning and Social Security strategy and preparing for year-end strategies. So we'll answer common questions about quarterly financial reviews and how to monitor and track your progress. So let's kind of dive in. You know, the most successful investors don't just set goals. They regularly review them and adjust them. As we move deeper into Q3, it's crucial to assess whether you're on track to meet your 2025 financial objectives or if you need to kind of reassess and adjust. A recent NerdWallet study reveals some eye-opening statistics about how Americans are doing with their 2025 financial goals. So let's kind of look at that and see what can we learn from this. Many Americans set financial goals for 2025, but many are not on track to achieve them. Only 24% of Americans have contributed to a retirement account in 2025. And that's alarming to me because retirement account contributions are really, in my view, the number one way to create and generate wealth as you strive to be financially independent. 6% of Americans have actually paused their contributions to their retirement accounts this year. 28%, so a little over 1 in 4 Americans set investing goals for 2025, not a great number, and only 19% set specific retirement goals. Now, there are some barriers, like what are some reasons for some of this? And I think there are some barriers that keep people from setting and assessing their goals on a regular basis. I think, according to this NerdWallet study, 15% of Americans with retirement goals cite not knowing what investments to choose. And it kind of goes along with that. I think paralysis by analysis or analysis paralysis, I think sometimes it prevents us from starting. We're not sure where to start. Even in a 401k plan, you know, you may have only 12 or 15 investment options. But, you know, for someone that doesn't follow investing regularly or track that stuff, it may be overwhelming to think about how do I go about doing this. Certainly, unexpected expenses can derail your plans. Do you have emergency funds? What are you doing with debt repayment? Certainly competing financial priorities can make goal achievement difficult. If you're trying to retire some consumer debt and you're contributing to a retirement account, how do you prioritize one or the other? So we'll talk about that today. So I think one thing is to, things are never going to be perfect. Things are going to come up. We need flexibility in our financial plan. We need margin in our financial plan. If you have a budget that accounts for every single penny and there's no room for any margin for free spending, those kinds of things, then it's not realistic. You have to have margin in your life. You have to have margin in so many ways, okay? But part of that is in your budgeting. I think saving consistently to your retirement accounts, even small amounts, can really help you build long-term wealth. So I think even if you're repaying debt and you have some high consumer debt, or you're trying to pay off a car at 6% loan, I think you should never stop contributing to your retirement accounts if you can help it. At a minimum, you should be putting into a retirement account, a 401k, a 403b, a 401. You should be putting in whatever your employer will match. Even if they'll only match 25 cents on the dollar, that's still a 25% return. That's free money. And so we should all be doing that. So what will your employer match? Make sure you're setting aside as much towards that as you possibly can, because it's free money. And then when you have unexpected costs, I think you just have to regroup and adjust your plan. But that's where you should have some margin, having an emergency fund, having some margin in your budget for some things that can come up. Now, if you're just really underwater, I think that you could consider their nonprofit credit counseling can sometimes be a help for you. Now, when we look at investment and home goals, 10% of Americans set goals to buy a home in 2025. Now, that's compared to less than 2% of people who actually purchased a home last year. And, of course, today's interest rate environment and home inventories are creating, a slowdown in real estate home purchases. 24% of homeowners have set home renovation goals. And I think when it comes to long-term investments, how should market volatility affect your long-term retirement investing? And this is something we talk about a lot. Market volatility, when you are regularly contributing to your retirement accounts or whatever investment accounts you may have, you get to profit from market volatility. Because if you're adding money every paycheck, with market volatility, inevitably there's going to be markets that are sharply spiking down. Think about what happened in April. There was a time in April where from the previous market high in, I believe it was February, the S&P 500 was off over 18%. So that week, if you were having a paycheck and you had payroll deduction going into your 401k, then you were buying while the market was down. And when you're doing that over time, it actually lowers your average cost per share. If you're buying a mutual fund at $10 a share, and then it goes to $8, and then it goes to $11, and then it goes back to $9, and you're constantly buying, the data and the research has shown that over longer periods of time, you will reduce your cost per share, your average share price of what you buy for that share. And that means whatever it's worth now, if your cost was lower, that means your profit is higher, right? So in other words, it has been proven to boost returns. So, when things look really bad and markets are correcting in a significant way, the last thing you should be doing is stopping your routine investments. If anything, we should be looking at how we can maybe invest more. But we definitely don't want to stop that. And sometimes I see people do that because human emotion can be a very powerful enemy of successful investing. And when markets are sharply down, that's where our emotion can sometimes get the best of us, and we sometimes make poor financial decisions. Likewise, when markets are way up, sometimes we make poor decisions the other way, and we buy into things that maybe we shouldn't be. Now, please don't misunderstand me. I'm not saying don't be investing in the market because it's at an all-time high. Because, that's as of today, but where's it going to be in 3 or 4 months? Markets were all-time highs at the end of May. And if you hadn't kept investing in June and July, or you had pulled investment out, you would have missed out on nice growth in June and July. Now, seasonally, we're getting into a time of the year, August and September, that historically have been some of the weaker times in the year in the markets, but the entire summer typically has been weaker. In historically, yet June and July this year have been pretty good in the markets. So I think the lesson there is don't try to time those things. Stay on path. Keep doing what you always do, which is investing through payroll deduction. Now, if you're retired, the market volatility can work against you if you don't have a plan to deal with that market volatility. Because what you don't want to do, when you're retired, you're not saving and investing money every month. To the contrary, you're taking out, withdrawing, and spending money. And that puts a completely different set of stresses on the nest egg, because that means when markets do spike down with volatility, you're selling off the investments and spending that money as income, and it can compound your losses. The money will never, ever come back because it's been spent. So that routine purchasing, taking advantage of market volatility that you're doing when you're in your working years, the exact opposite can happen in your retirement years. You've got to have a financial plan that can provide income where you don't have to be selling off market investments when they inevitably correct downward. So these are just a few things that you can be looking at as you kind of review it going deep into the third quarter, and we're going to be getting into the fourth quarter here shortly. Doing that quarterly review, it's not just tracking progress, it's making strategic adjustments to help ensure that you finish 2025 strong. So conduct a thorough financial review. Now, that can require expertise and objectivity that can be difficult to achieve on your own. Certainly at Brogan Financial, that's what we do. We can help you objectively assess your progress, identify areas for improvement, and help you develop actionable strategies for the remainder of the year. So whether you feel like you're ahead of schedule and you want to maximize your progress, or you're behind on your goals and need a realistic plan to catch up, we're here to help you create a strategy that can work for your unique situation. So, you can give us a call, 865-862-6800, or you can sign up online, go to broganfinancial.com, and you can register for a complimentary consultation. When we come back, we're going to discuss how to rebalance your investment portfolio to position yourself for quarter four success and heading into 2026. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm Jim Brogan, and we're talking about financial success, reassessing your goals in 2025. As we are now headed into August, we're getting just a couple weeks here. We'll be halfway through this third quarter of 2025. This year has brought significant market movements. How should you be handling portfolio rebalancing? Adjusting your investments for success moving forward. One thing that's interesting this year is international stocks are pretty significantly outperforming U.S. stocks in 2025. And that's after years of underperformance when comparing international stocks to U.S. stocks. And those shifts mean your portfolio allocation may have drifted from your target. What if you have hedges with things like precious metals? Gold's at all-time highs, near all-time highs. What does that mean for the balance of your investments? These shifts mean your portfolio allocation may have drifted from your target, which could potentially expose you to either more risk than you intend or less risk than you intend. So let's explore how to strategically rebalance your portfolio. How often should you be looking at all of this? Typically, international stocks and U.S. stocks, it kind of move in cycles, right? But up until this year, U.S. stocks, by several years, have had the longest period of overperformance as compared to international stocks than we've ever seen. And this year, that has changed somewhat. International stocks are doing better. And now, how has that affected your portfolio? Your portfolio may be heavier in U.S. stocks and lighter in international stocks than you really intended. Or are you too heavy in international stocks now? Some of the overperformance of international stocks, I think, could be assessed by a decline in the U.S. dollar has helped boost foreign denominated investment. And that's already baked into the numbers now. So you do have to be careful. If you just say, hey, I'm going to buy more, you're buying in while it's up. So what is the right answer? How often should you be rebalancing? How often should you be looking at all of your mix? How much do you have in large cap U.S. stocks versus small cap U.S. stocks? In your international mix, how much do you have in emerging markets? What is your bond exposure? How are you hedging extreme downside risk to try to avoid that big 30-40% decline? If you haven't rebalanced, you may find that you're really off target. If you're within, and the length of time you have until retirement can also play into this. If you're within 10 years of retirement, you should probably be paying more attention to allocation drift of your different asset classes than if you're, say, 25 or 30 years from retirement. But let's just look at this. Many people rebalance, many firms I have seen rebalance monthly and quarterly. And in my view, if you look at the research and the data, that is too much. And some people would recommend doing an automatic annual rebalance. I think that's better than quarterly. But some data would suggest you shouldn't rebalance but every several years. What is the right answer? There's a lot of data and a lot of research that supports the idea of momentum of asset classes. And, one of the things that's challenging about rebalancing is you're selling off your best performing investments, you're shaving some of that exposure off, and then you're buying more of the underperforming investment. Emotionally, that's very difficult to do. And if there is some good historical data around momentum of asset classes, meaning as asset classes have momentum, sometimes they continue to follow, you want to take advantage of that momentum. So if you're rebalancing every month or every quarter, where you're selling off the best investments, shaving them off, and taking that money and buying into the more poorly performing investments, sometimes you can just stoke off that momentum. So what's the right answer? I think annual rebalancing is one option. My preferred method is to track it manually, and to have ranges. So, for example, if you want your stock mix to be 70 to 75% of your investment portfolio, for stock, that might not be a big enough of a range. Maybe you say you want it to be between 65 and 80% of your entire investment portfolio. And just kind of track it in those ranges. If it's getting up near 78, 79%, you might be taking on more risk than you really want to. That might be a time to start shaving some things off. Likewise, if it's down around 67%, 66%, maybe that's a time you look at going back in and increasing your equity exposure. Likewise, if, let's say you want to have a mixture of real estate and traditional real estate investment, and you want that to be between 5 and 10%. That would be appropriate. If you're feeling particularly bullish about real estate and real estate is kind of hot, you might let that get to 8 or 9 and start pushing up closer to 10%. But then if you get over 10%, I've got to rebalance this, because now you're starting to bet on that investment asset class. And that's what you don't want to be doing. You want to give, in my view, investments the ability to capitalize on momentum. But at the same point, you don't want to let a specific investment or asset become an oversized portion of your portfolio where now you're betting on that asset class and you're taking a risk on it. So in my real estate example, if your real estate investment got up to 12 or 13 or 14%, and your target is to never be higher than 10%, then all of a sudden you have enough of a position in real estate that if there was a real estate bubble that burst, then you could really have a negative impact on your your performance moving forward, and that's where you've got to be very, very cautious. So I like managing it in ranges, and then when you start to get near the high end or low end of ranges for a specific asset class, that's when you would look at doing a little bit of a rebalance. If you are going to do an automatic rebalance, I think no more than annually. But, there can be markets where you want to rebalance more frequently than annually. So I'm a big fan of tracking it manually. Of course, that's what we do. That's what we do at my firm. So we have tools to be able to do that. If you're a self-investor, you handle things on your own, you may not have all those same kinds of tools. There are some very good software tools out there to help you track and monitor that stuff. If you don't want to get that into it, that's where you could look at doing an annual rebalance. Maybe you go in once a year and you just get it back in line. So I think, but you've got to watch this stuff. The reality is most people with their 401ks, as an example, they set their 401k investment allocation. How long has it been since you adjusted that allocation? In terms of both the current investment that's in the 401k and your new systematic investment that's going in every paycheck. How long has it been since you adjusted that mix? And, number one, you're getting older. You're getting closer to retirement income, so that probably needs to be looked at again if it's been a while. Number two, things could be getting out of whack based on some of the things I've just talked about this segment, and needs to be rebalanced because you might be taking too much risk in an area that you don't really intend to be. So I think it's very, very important to do a good, thorough review of your current investment mix. Look at those asset classes. Do you understand the risk that you're taking? And do you know what that risk looks like? I'm a big believer in planning for volatility before it happens. And the good part is we have tools now that we can measure risk in a portfolio. And measuring historic risk, like when you're doing that, what you're doing is you're looking at whatever's in a current investment portfolio, and it's looking at the historic risk. And it's looking at statistical metrics like standard deviation and how correlated is the movement of that portfolio relative to, say, something like the S&P 500. It's looking at a lot of statistical data. It's based on historical risk. And research has shown that historical risk can be a pretty good predictor of future risk. We know there's no sure things. You never can count on markets. But as a rule, we can measure risk in a portfolio and have a pretty decent idea, not for how much am I going to make or how much may I lose in various markets, but if the market does X, what can I expect out of my portfolio within reason? If the market is down 30% in a bear market, what can I expect out of my portfolio. Likewise, if we have a really good year, a 25% upturn, I mean, we've had 2 years in a row where the S&P 500 was up over 20%. What can you expect out of your portfolio? And it's a balance of risk and reward. Nobody wants to lose money, but we want to make money. And we got to measure that stuff. So if we don't want to lose as much inevitably when there's a market downturn, then that means we're probably not going to be able to make as much when the markets are soaring. So we have to do a balance of those things, but you have to start with understanding the risk in your portfolio and, how much risk can you afford to take? If you're 20 years from retirement income, you can afford to take more risk than someone who is 5 years from retirement, right? Because you're a lot further away. If you're 20 years from retirement, you're a lot farther away from needing to start to pull from your investments. But then also, how much risk do you want to take? And I think that's important for behavioral management. We're humans. We have emotion. And when markets are substantially down, and when they're soaring, that's when we tend to make mistakes. So be sure you're assessing risk and looking at the downside potential in your portfolio and also what that means for the upside. We know that markets over time have been efficient. The question is how much time? It might take 8, 10, even 12 years to prove out to be efficient. So how do you deal with volatility in the meantime? How do you deal with income needs and things like that? But now, one other thing I do want to talk about before I leave this question of rebalancing is you do have to consider tax efficiency. Because, if you're rebalancing and you're selling some investments and buying some other investments in an IRA or a 401k, there's no tax impact of that. But if you do that in a traditional investment account, there are tax ramifications. And you don't want to let the cart drive the horse. You don't want to get the cart before the horse, I guess is the best way to say that. You don't want to be making investment decisions where tax implications are the number one reason you're doing something, but you definitely need to consider tax ramifications. One way to solve that issue is when you need to be rebalancing is if you're systematically adding money every month to your investment account, well, change how those automatic investments are going in. They could be your automatic monthly systemic investing could be going into the ones that are performing a little bit more poorly and need to be boosted, and that'll help get you back into balance, without having to sell off and have tax implications on investments. But the biggest thing is to understand that portfolio rebalancing is so important. Most people don't really even address it, but you also want to be careful you're not doing it too frequently. So be careful. Be sure that you're watching the allocation in your portfolio. Is it drifting into areas that could be dangerous for you, either with taking too much risk where a market correction could be more devastating than it needs to be, or you're not taking enough risk to get the growth you need to be over the long haul. We're going to get to our next break. When we come back, we're going to talk about retirement account optimization, maximizing the new catch-up contributions that are in place for 2025. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in. This is More Living with Jim Brogan right here on News Talk 98.7 WOKI. And we're talking about getting your affairs in order for the back half of the year. We've talked about portfolio rebalancing. I'm going to go through the new retirement account contribution limits and make sure you're optimizing your retirement account. By the way, do check us out online, broganfinancial.com. We've got a wealth of resources. My next college class is Income Planning for Retirement. It's at Pellissippi State. It's on August the 26th, 6:30 to 8:30 p.m. You can go to PellissippiRetirementPlanning.com for more information, or go to my website, broganfinancial.com, and click on classes. You can click up a syllabus And then you can click to register. It's just a one-night class specifically on the unique challenges and opportunities of retirement income planning. That includes a segment on, of course, Social Security election. It includes a segment on tax planning, on anything at all that could be a major impact on your retirement plan that's specifically driven by how you structure retirement income. You know, if you're 50 or older, 2025 does bring some new exciting opportunities to recharge your retirement savings. We have enhanced catch-up contribution limits that kicked in this year because of the Secure Act 2.0, which was passed a few years ago, and particularly for those that are aged 60 to 63. And specifically what that means is at the end of this year, if you'll be between age 60 and 63 at the end of this year. All right, so if you're born in 1965, I guess you'd be 60 at the end of this year. 1962 would be the start of that. You have super catch-up contributions. So let's talk about those. The standard 401k contribution limit in 2025 is $23,500. So even people under age 50 can contribute up to $23,500. If your plan offers a Roth option, then you can put up to $23,500 in either the traditional IRA or the traditional 401k or Roth, or you could even mix the two. If you're over 50, by the end of this year, again, that's measured as of December 31st of 2025. If you'll be 50 or older, you get an extra $7,500. So you can put in up to $31,000 of your income can be deducted from taxable income if you're doing it on the traditional 401k, or you can do it on the Roth. And there is no income limitation on a Roth 401k contribution, while there is an income limitation on a Roth IRA contribution. So it's important to know those things. Now, for an IRA in 2025, you can contribute $7,000. And if you're 50 or older, you can do an extra $1,000 for a total of $8,000. Now, I mentioned this enhanced catch-up if you're going to be between 60 and 63 years old at the end of this year. You can actually go up to $34,750. So it's an extra $3,750 that you can now do if you'll be between 60 and 63 by the end of the year. So that's a significant opportunity for those of you that are right on those last earning years, and maybe you're in your peak earning years, usually in those last years, and you have an opportunity to put even more money into a retirement account. Now, many of you, if you're in your peak earning years, you're going to want that deducted from taxable income, and you'll want that to go into the traditional 401k. But many of you may believe in the future of Roth being tax-free in retirement. You may say, I want to put that in the Roth side. Now, I do want to make a mention, anything that your employer contributes does go into the traditional 401k side. Okay, not the Roth, because you're not taxed on the employer contribution. Whereas if you're putting your own contribution into the Roth 401k, you are taxed on that contribution this year. So any employer match is going to go into the traditional 401k. So, you can get some significant tax deduction opportunities by using these enhanced catch-ups. Again, it is based on your year-end age on December 31st of 2025. Now, not all employers have implemented these enhanced limits. This extra $3,750 that you can do if you're between 60 and 63 at the end of this year. According to the data, 97% of employers have implemented that, but you do have to make sure that your employer plan has implemented that. Now, what if you weren't aware of that, or here we are in August, maybe you were aware of it, but things are going well and you'd like to put more money in? What do you need to be doing? You need to be finding out from your 401k provider, how can that be handled between now and the end of the year? Sometimes you can only make changes to your contributions once or twice a year in terms of the amount you're contributing. Can you go to December and then do a higher elective contribution to get to the max? You may not be able to. So if that's the case, you'd want to know now so that you could be making systematic contributions. If you're allowed to do that, you could go ahead and bump up your contributions so that by the end of the year, you get to that maximum catch-up. So very, very important to understand the plan rules from your 401k provider. That and by the way, that's if it were me, I wouldn't call my HR desk. You could if you have a good relationship and they're really on top of the 401k plan. But typically you would call your 401k administrator, whoever that is, the investment company that houses the 401k investment. They're going to have those plan rules on file. When you call them, the rep will be able to look that up and find out exactly what those plan rules are. So do find out what you're allowed or not allowed to do so that you don't get stuck towards the end of the year and cannot take advantage of all of these things. Now, there's also HSA catch-up contributions. If you're 55 or older this year, you can do an extra $1,000 into a health savings account. Now, if you make too much money to do a Roth IRA contribution, then I do want to briefly talk about something called a backdoor Roth. A backdoor Roth is, there's no limit on making a contribution to an IRA, a traditional IRA. Where you get into issues is if you make too much money, you cannot do a Roth IRA contribution, or you can do a traditional IRA contribution, but you do not get the tax deduction on the IRA contribution. And as a rule, I don't want to put money that I'm not getting a tax deduction into a traditional IRA. However, if you don't have any other IRAs, what you can do is contribute money to a traditional non-deductible IRA. There's no income limitation on that, and then you can turn around and convert that money to Roth. So you could add, let's say you're over 50 this year, you could add $8,000 to a non-traditional IRA. You do not get the tax deduction on it, but then you can convert it to Roth. There's no additional tax because you didn't get the tax deduction to begin with. Now, if you have another IRA, you could run afoul of the rules because the IRS uses a pro rata rule. If you start a new IRA and put $8,000 into it, but you've got another IRA that's worth $92,000, then you've got total IRAs of $100,000. And if you do a conversion, the IRS uses a pro rata rule, so 92% of that conversion is going to be fully taxable. So I don't want to get too complicated and pull have your eyes glaze over. But bottom line is, if you have existing IRAs that are a pretty good size, backdoor Roth is probably not going to be a good solution for you. But if you're a high earner, backdoor Roth is something that we use for a lot of our clients, that we can get more money into retirement accounts, either on the Roth side or on the traditional side. And that is the best place to compound wealth because you don't worry about tax implications every year as that money is growing. We are going to get to our last break. And when we come back, I want to do some year-end strategies for tax planning and also Social Security optimization as we get closer to the fourth quarter of 2025. So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in this week. This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. You can catch us every Saturday, 9 to 10 a.m., and again from 3 to 4 p.m. We also podcast all of our shows. You can stream them live at News Talk 98.7. You can also, we'll have our show, today's show podcast on my website. You can stream it the Tuesday afternoon. We'll also have it up on Spotify and Apple Podcasts. So do check that out, More Living with Jim Brogan. Also, we have a wealth of information on our website, so you can have important education that can help you make informed and prudent decisions to impact the quality of your life. Go to broganfinancial.com. Check that out. I mentioned my next class, Income Planning for Retirement, is at Pellissippi State on August 26th, 6:30 to 8:30 p.m. Go to my website, broganfinancial.com. You can click on classes. You can also go to PellissippiRetirementPlanning.com. Now, what are some tax planning opportunities, tax considerations for the end as we approach the final quarter of 2025? So first off, did anything happen with Social Security taxation? And this has come up. I've had two people come in my office this week that thought that the big, beautiful bill fundamentally changed taxes on Social Security income, because, you know, that was one of the things that Trump had talked about in his campaigning was no tax on Social Security. In fact, the big, beautiful bill did not make any structural change to how Social Security income is taxed. So we're still using the same numbers from the 1980s and the early 1990s in terms of how much income you have affecting how much of your Social Security income is subject to taxation. Up to 85% of your Social Security income is subject to ordinary income tax. The more money you make, the closer you get, and then you hit the 85%. However, no matter how much money you make, 15% of your Social Security is tax-free. So none of that fundamentally changed. What did change is they added an extra tax deduction. On a standard deduction now, if you're 65 or older, you automatically get an extra $6,000 tax deduction per person. That's only for 2025 through 2028. So the messaging out of the big, beautiful bill was that extra tax deduction for people 65 and older is meant to be an offset for some of the taxes you have to pay on Social Security income. But there was no fundamental change to taxation on Social Security income. So I want to clear that up, number one. And then what are some minimization strategies you can be aware of as we get towards the end of and get through into the third quarter of 2025? Certainly, if you delay your Social Security income, that can provide potential tax planning opportunities because now those numbers are not showing up on your tax return. Likewise, if you are 70 and a half, you have the ability to do qualified charitable distributions where you can give money directly from an IRA to a church or charity, and it is not a taxable distribution. So think about how significant that could be when you turn 73 or older. You know, if you're born before 1960, then the year you turn 73, you have to start taking taxable distributions from your IRAs and other retirement accounts, and that is forced taxation. Now, if you're born 1960 or later, you have to do that at 75. But as an example, let's say your minimum distribution is $20,000. Let's say you're giving $5,000 a year to your local church. Well, over 90% of taxpayers aren't itemizing anymore with the high standard deduction, so you're not getting any tax benefit from that charitable contribution. But if you give that $5,000 out of your RMD, instead of being taxed on $20,000 on your RMD, you're taxed on $15,000. So it comes straight off both your adjusted gross income and your taxable income. So it is a huge opportunity for those that are 70 and a half and older, especially once you get in the year you turn 73. And then finally, you should be looking at year-end tax planning opportunities. Things like, do you have investments in an investment portfolio that are down? Or do you have bond funds that may not be down but still have taxable gains because of the dividend distributions and understanding how taxable distributions work from mutual funds? Likewise, should you be looking at Roth conversion opportunities to fill up a lower tax rate if you're worried about higher taxes in the future? So these are just some of the things you can be looking at with your year-end tax planning. We'll do an upcoming show as we get closer to fourth quarter, specifically just on year-end tax planning. But today we've discussed your wealth because greater wealth provides for more living so you can live the best years of your life your way. Do check us out online, broganfinancial.com. Go to PellissippiRetirementPlanning.com to learn more about my income class on August 26th. Thank you for tuning in. Thank you to Wayne. Thank you to Jill. You've been listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.